So guys, after discussing the basic of derivatives, options and futures, we'll move on to forex derivatives. This is a mixture of your forex chapter and how derivative contracts, the options and futures are used for hedging that. These concepts are in your study material. They are not there as a separate chapter like how we are dealing. They are included in your forex chapter only. But since forex was our first chapter, at that time we did not cover derivatives, so I had to keep it pending. So now that that is done, immediately we are covering up. So anyway, sir, forex hedging low, there are two type of sums only. Either you will have a currency option or you will have a currency future. And because derivatives only two products are there. So either currency option or currency future. Tell me which one do you want first. Now that you know both, for me anyone is same. Currency futures you want, options you want. I just ask sir casually, don't mind. You also casually told, huh? Very, very important, sir. Highly important chapter. You see, derivatives, we invest so much of time, understand, do so many questions, 100 odd questions and all. Ultimately, exam lo, sir, what they are asking is on call option, strike price, 5 prices, workout payoff. Or they'll give you simple data, workout risk neutral method lo option value. Or just now you have seen one sum, no, contango backwardation simple sum, a type of sum. Sometimes good questions also come, but generally off late the trend is easy questions they are asking in derivative. So then what is the purpose of learning all that, sir? Each chapter. Applications. So our derivatives, forex mix, and if he asks of no sir, he can cover 2 chapters in a single shot. That's the advantage. And then without derivatives you will not understand a bit also of IRRM. IRRM is interest rate risk management. That is one chapter. Many people even leave it also. They don't even know what is there inside. But you will be pro. You will be pro. Because you have developed all the base for that. It just you have to link up to interest rates. Underlying asset we have seen shares, Nifty, commodity. Now we are seeing currency. Only one fellow is left in interest. That fellow will be covered in last chapter, IRRM. So there we will handle that fellow. Rest all derivative applications will be done here. So anyway, currency options or futures. Which one is difficult? No, difficult in terms of sums. Options. Put the heading. Futures you just now did know, so you will be obviously a little bit sharp. We don't want that. Sir. Right. Point number 1. Go on writing, sir. If you have any doubt at the time you ask me. I could have printed this. In fact, I have this printed also, but I did not include this in the book yet. Because this is something which you have to understand whole and soul. These are option contracts. With currency as underlying asset. Currency options can be used for hedging of foreign currency exposures. A currency call option gives the holder a right to buy underlying currency on future date at predetermined strike price or excess price. Sir, this is absolutely within your knowledge already that call option will give the holder what? Right to buy. Same point only next line, right? A call option is beneficial to holder when, tell me sir, market price is likely to increase or decrease? Increase, otherwise option will be lapsed. So the call option is beneficial to holder when the price of underlying, since it's currency now I'm calling it as currency is expected to move up. So rising market low, you should become a holder of call option. That is the whole summary of this second point. Same to same right for put option. A currency put option gives its holder a right to sell underlying currency a put option is beneficial to holder when price of underlying is expected to move down. On entering into options contract, the holder of option has to pay premium to writer of option. All these are your option basics, sir. Everything you know, just like that. Since it has been some 7-8 days you finished option, so safe side. Here only you write holder of option. Let it be any option called as what? Buyer of option, also called as having a long position in options. The call or put is irrelevant for you. Writer of option, also called as seller of option. Short position. Last point, sir, this is something you should fill up. I will only tell you the box. Okay, so type of option. So at maturity date, spot price, or let me write like this, future spot rate greater than strike price. Another case, future spot rate less than strike price. Copy the table. Future spot rate means on the maturity day, whatever spot rate. You simply have to tell me lapse, exercise, lapse. So tell me, sir, first one, call option. Next we will talk about put option. Call option gives us a right to buy at strike price. So market price is more than that. So I have a right to buy at a lower price. Definitely we will have to exercise. In case of call option gets lapsed. Here put option gets lapsed because price in the market is better. So even though I have a right to sell at strike price, market price is higher, my price is lower. But in another scenario, I have a right to sell at strike price, but market rate is lower than that. So my price only is higher. So here you will exercise. Payoff from options. On maturity date. Option lapsed. Option exercised. Option lapsed. Payoff is equal to 0. Option exercised, then I will have to ask you which options is. Payoff for call option is equal to, what's the formula? SP minus X, correct? SP is spot rate, X is strike price. So spot rate minus strike price, or like you remember, SP minus X will do. Payoff for put option only when it is exercised. Strike price minus future whatever spot rate is there. Here also please write future spot rate, because today one spot rate will be there. No, you should not get confused with that. Of course, it's too basic, but still safe side. Sir, in this important point is, even if option gets exercised, there is no delivery of underlying currency on maturity date. Sir, call option, I have a right to buy, I exercised, so I will buy dollar, give me dollar, and nobody will give you like that. Foreign currency, you cannot hold like that, no sir. FEMA laws will not permit you that. So then what will happen? Only payoff is paid by whom? Writer to holder. Reverse also is impossible. No, holder will not pay anything to the writer. Writer only will pay to the holder if the option gets exercised. Option gets less, that also will not happen. Sir, up to here it's pretty basic, sir. Now here onwards, how to hedge you will see. This is new aspect for you. Up to here, even in derivative options also, you must be remembering all this, but this will be a kind of reminder for you. Sixth point, sir. Put the heading. Hedging a FC receivable. A foreign currency receivable if you are having, how will you hedge? Sir, first you watch, later completely you will copy. Okay, timing watch. Sir, you are an Indian company. And you have a dollar receivable. Not now, at 3 months time you are having. When you actually receive the dollars, what will you do? You will have to convert it, correct? So you have to sell the dollar and you have to buy, or you are converting to rupees. No? So basically you will give dollars and you will receive rupee from the bank. All these transactions is going to happen at what time? 3 months time. Okay, right. Sir, how to hedge, sir? Because after 3 months, what rate will be for the dollar will be there? I do not know. No. One route you already know. What is that? Lock the rate by entering into a forward. That is anyway there. You can do money market hedging also. Right? Since I have a FC receivable, create a FC payable by making a borrowing in foreign bank. All the drama you remember. So that is one hedging. Third hedging is this one. Currency hedging. Currency options hedging. So how to hedge this is, first you have to understand what are the risk involved. What is the risk involved? You understand risk involved, game over, sir. Risk involved for Indian company. Tell me, sir, what am I going to do here? I am going to do two things, ma. One is I am going to sell dollar and I am going to receive rupees, and I am calling it as I am going to buy rupees. Correct? At 3 months time I am going to sell dollars, I am going to buy rupees. Tell me, what is the risk? Dollar may fall, that's all. Risk involved is a dollar can fall. Dollar may fall at 3 months time. Same thing, I can also call it as rupee may rise. Sir, tell me, dollar falling, rupee rising, both are same only, no? But one is from dollar's point of view, the other one is from rupee point of view, but they both are signifying the same risk, isn't it, sir? It is not like one will happen, the other will not happen. No, if one happens, definitely the other one also will happen. Of course, I do not know whether it will happen or not, isn't it? Is it sure that dollar will rise or fall? No, I do not know, but that's the risk involved. Risk means uncertainty, no, sir. So, e risk you go and give medicine. Medicine is very easy, sir. Hedging route 1. Tell me, sir. Dollar is likely to fall. If it falls, you will feel bad. Tell me, which option can you buy which will give you gain if price falls? Call or put. Just now you wrote no, sir. You have only two choices, sir. Holder of call or holder of put. Only two choices. Call option, if you buy, what will happen? If dollar falls, call option gets lapsed. A premium also loss. So don't buy call option. In a falling market, you have to buy put option. So hedging route 1 is buy put option with dollar as underlying asset. This is one route. or hedging route 2, this you can guess. Rupee may rise, and no short positions, sir, only long positions, because writer positions are too risky. You cannot take writer positions for hedging, only take holder position. Tell me now. One action you told me with the dollar as underlying asset. Now the other one is with the rupee as underlying asset. Rupee may rise. If rupee rises, I'll suffer loss in my real market at 3 months time. So I should gain in options market when rupee rises. Which option will give you gain when price rises? Call option. So the answer is buy call option with rupee as underlying asset. Sir, any doubt in this? Sir, in the exam question between these two, which one I will do? The question will tell you. Sir, put question lo entire data is given with the dollar as underlying asset. Indirectly hint is what? Go and take a put option on dollar. So how can you take call option on rupee when question of data is not there for rupee? Are you understanding, sir? So question some information hint will be given as to which route he will follow. But definitely only two routes. You cannot take writer positions and all, no short positions, only long. So never become a writer for hedging, because already you have a risk. Writer position is also risky. So generally we don't take writer position. We don't have any single question also where writer position is used for hedging your risk. Although it's not impossible, we can still do. But I don't want to confuse you. This will be confusing as you go further. Copy this. Sir, any doubt in risk? Means a risk, how did you get in? I'm going to sell dollars in future. So spot rate of dollar can fall, that will hurt me. A dollar falling means rupee rising. That much also you can't think. Look at the diagram. Our diagram arrow marks, whatever are there, that one is your risk. Dollar down arrow mark, no sir. So dollar fall is risk. Rupee up arrow mark, rise is risk. Worst case low. Some rope for saving life. Whether to do route 1 or route 2, I will tell you guidance. Of course, question hint will be there, but that also will factor in our note, safe side. Sir, buy put option means you must understand you are becoming a holder of put. Here you are becoming a holder of call. Sir, it's not like you cannot become or should not become a writer. Only thing is your examination questions are not like that. I said never did any writer positions for hedging. So you would definitely not like to be different. They don't like in that case. 99 people write wrong answer also, they'll feel that as normal. So taking writer position is not wrong actually. You can hedge using writer positions also, but when the institute is not doing, don't go against that. Sir, copy it out. Chalo. Next, hedging FC payable. Example, Indian company will not be there. So it is only for base setting up. Questions for UK company, Europe company, having pound receivable, e type of questions you will find. But if I start with that today, your base setting, the problem will come. So imagine this fellow has a FC payable in dollars. At 3 months, not now. So at 3 months, obviously he has to buy dollars by giving his home currency, which is rupee. Risk to Indian company. Sir, I have to buy dollars by giving rupees or selling rupees. So risk is dollar may rise at 3 months, or I can also view it as the rupee may fall at 3 months. They both are not independent events, but why we are writing both is using this each risk one position you can take. Remembering it will be easy for you. Two roots remembering. That's why both angles I am writing. So your hedging route 1 tell dollar may rise, it seems, so you will buy call option with the dollar as underlying asset, or rupee may fall. For a fall, if you in a falling market, if you have to gain, you should buy a put option. Rising market lo call option you have to buy, falling market lo put you have to buy. Buy put option with rupee as underlying asset. Next, sir, out of these two hedging routes, which one? Which hedging route to be selected first thing, it is not your choice. You cannot decide, sir, I feel dollar is better, put option, not like that. Question of data you have to see, accordingly you have to select what is applicable for you depending on the information given in the question. Selection means don't imagine too much, not like that. So we have to buy call option or put option. This much clarity you should have. Definitely you have to buy call option or you have to buy put option based on the underlying asset given in the question. The examination point of adjustment, not real time. Real life you will sit and decide what is beneficial for you and all. But exam lo, sir, go and check what is your underlying asset data. For example, you are having this FC payable scenario. You have two routes. But question entire data is only about call option on dollar, put option on dollar, like that. He's talking only about dollar as underlying asset. In the entire question, the data is on dollar as underlying asset. How will you even think of taking a put option with rupee as underlying asset? Obviously, you will not take. No, you will have to go with only root 1. That's the point. But your examination questions are much more criminal than that. What they will do is, they won't tell you who is underlying asset. The dollar and underlying asset, they tell you no, then you will pick up the call option, you have to do hedging. Or rupee, and if they tell you put option, you will take. So dollar or rupee, which one is underlying asset, and directly they won't tell you. Sir, then what to do? I'll make you, okay, first write sir, later on I'll tell you. If underlying asset currency is not directly given, we can still identify using a lot size, put a hyphen and write lot size currency is underlying asset. Lot size is $50,000 and he will tell you, that's all. A dollar is the underlying asset for that sum. So that is a hint you have to pick up from there. If lot size also is missing, then one more check is option premium. Option premium will be in a currency other than underlying asset currency. So go and check option premium is in which currency. If option premium is in some currency, they will give our currency is not your underlying asset. The other currency that is there, that will become your underlying asset. Like that you have to catch. If hints, sir, the question does not tell you who is the underlying asset. Sorry, hints only we did not understand. No problem. Look at this. Suppose there is a call option on RIL share. Okay. Tell me, sir, who is underlying asset here? RIL share. Okay. Strike price, let us say 2,500. Maturity 3 months contract. Lot size, let us say 1,000. What is 1,000 rupees? Units. Units means what here? Shares. Which company share? Axis Bank. RIL shares. Premium, some, let's say 25 rupees. The call option ITC. In this there is no doubt, it's everything very pretty simple. Look at this. Side by side, I'm writing call option on dollar. Underlying asset will be dollars. Strike price is $1 is equal to, India has reached to latest high. Very nice. $1 is equal to rupees 84. Strike price. Maturity 3 months. Lot size $1,000. Premium is 1.20 per dollar. It will be like this, sir. And what I want you to observe is, observe data in Reliance share, then you will link it up to dollar option. Okay. Look at the first call option. Tell me, sir, lot size is in which units? 1000, what is that 1000 rupees? Shares. Which company shares? That means a lot size will always be in underlying asset terms only. Clarity is there? Like that. Come to right side. Lot size is in which currency? $1000, which is also nothing but underlying asset currency. Do call option on share when you do, so here confusion will not come, because there are two things. One is price, which is 2500 rupees. Underlying asset is what? Share. So price is in rupees, underlying asset is share. But when it comes to currency options, what problem you will face is price also is currency, underlying asset is also one currency. So here confusion will come. And now at least less confusion, because I am talking about rupee, a dollar. You will have unknown currencies while doing some. Who is underlying asset, who is price, and a confusions will come. So for that hint is a hint is very powerful. When you do sums, you will understand. So go and watch who is lot size. Lot size is in which currency? Lot size currency A, underlying asset currency. Okay. This is hint 1. Hint 2. Come to first example again. Premium is given as how much? 25. 25 into the share or rupees? Premium for call option on Reliance share will be 25 shares. No, it will be in rupees. Likewise, come here now. Premium for call option on dollar cannot be in dollars, no. Like how premium for call option on Reliance share cannot be in terms of Reliance shares, like that premium for call option on dollars will not be in terms of dollars, it will be in terms of other currency. So, e rupee, whatever is there, this is not the underlying asset. The other currency that is there in the question, that fellow will become the underlying asset. Who is that? Dollar. Adi hint, sir. Am I clear here? In the normal share, why will I get confusion? Everything very clear here. Here problem will come because both are currencies. Price is also currency, underlying asset is also currency. Definitely confusion will come, but you hold to this hint, pakka you will come out of that confusion. So till here any doubt? Okay, nice. 8th point is done. 9th point. If you want, you can write this. Not required? Okay, if it is not required, chalega. Then lot size is your underlying asset. Premium currency, not underlying asset. Similarly, rupee, here not underlying asset. This fellow is your underlying asset. There are questions, sir, where they'll trouble you with this, and if you can't make a judgment here over some, where you have to take call option on dollar, you will end up taking put option on rupee, some over, first step lone gone, entire 12 marks over. First step should be a very crucial step. Okay, we'll do a couple of examples, sir. One for FC receivable hedging, one for FC payable hedging. Two examples we will do. Once the examples are over, small examples, sir. Once these examples are over, one very important conclusion you are going to write. Our conclusion, if I tell you directly as a rule, it will be very confusing. Our conclusion people don't write in books. I say won't write anywhere. Answers are they will do off. And in 1-1 sum, 1-1 presentation they will do. It will be highly confusing. So we'll try to develop an example. From there we'll develop the conclusions. Our conclusions, so if you see the sum, it will look very cheap. Sorry, chapter is heavy only. These forex derivative questions, even though they are mixed along with forex, they are not that simple questions. For this, very careful analysis is required. Anyway, sir, come to this example. Write an example with me. Indian company has FC receivable of $1,000 at 3 months from today. So FC receivable. Now you will peacefully think inside and tell me what are the hedging routes. You are going to receive dollars. The dollars you will sell to the bank, and from the bank you will receive rupees or buy rupees. So in future you are selling dollar, you are buying rupee. Selling dollar, what is the risk? Dollar price may fall. So what is the answer? Buy a put option on dollar. Rupee I am buying. What is the risk? Rupee rate may rise. So buy a call option on P. Two routes are there. This fellow is doing, the company hedged the risk by buying a put option on dollar. Very clearly I am only telling you the action also. At the rate of $1 is equal to 82. Premium paid is rupees 0.50 per dollar. At maturity date, what will happen? We will see. Two scenarios I am assuming, sir. Case 1, spot rate or 3-month spot rate is equal to $1 is equal to, I have a right to sell at what rate? 82. Let us make it 84, or let's make it work first. 75. Case 2, $1 is equal to 84. First and foremost thing, sir, when your customer gives you $1,000 at 3 months time, that $1,000, tell me, can you sell directly under put option? No, because delivery is not there. Puts can be settled only in cash payoff amount. That too when options are exercised. If options are lapsed, you can't do that also. So when the customer gives you $1,000, what you have to do? Simply go to the bank and convert into rupees using that day ka prevailing spot rate. So write that only, first point. Convert dollar received at spot rate prevailing at 3 months time. So in first case you will receive rupees 75 per dollar. Here you will receive rupees 84 per dollar. Tell me which case you are happy, which case you are sad. First case you are sad. Why? Dollar rate has fallen down. You sold your dollar at a lower rate. Second case, dollar you are able to sell at a higher rate. But did you already hedge or not? Hedge. So hedging will protect you now. B. Payoff received from put option. What is the strike price? 82 per dollar. I have a right to sell the dollar under put at 82. Market low price is 75. Will I excise or lapse? Will definitely excise. If I excise, I'll get payoff. How much payoff will I get? 82 minus 75. How much is that? 7 rupees. So here rupees 7 per dollar. How did you get 82 minus 75? Definitely inflow. You are holder, no sir. E75 already inflow ne. This is also inflow. Here nil. Why nil? Put is lapsed. Sir, normally when you buy a put option and put option got lapsed, you are happy or sad? Normally when put option you buy and put option got lapsed, you are sad. But here he will be happy. Why? He is not a speculator with put, he is a hedger. If put is lapsed, he will not bother because a stupid 1.5 rupees is wasted, 50 paisa is gone for premium. But put is getting lapsed means my dollars are getting converted into rupees at a higher rate. Isn't it, sir? Option premium is loss, that's all. Okay. But I am getting more rupees for every dollar, no? So even if put a lapse also, I don't mind here. Work out the influence total. Not premium, sir. I'm talking only about maturity date. Total inflow at 3 months time will be equal to this 75 plus 7, which is rupees 82 per dollar. In this case 84. Of course, premium outflow was there at the beginning, that also a factor, but anyway. Sir, explain, how did put option protect him? When the price of dollar has really fallen down, that means whatever risk you anticipated really happened, at that time put option gave you a payoff and it ensured that your inflow will be equal to 82, and 82 is what? Strike price. 82 is nothing but strike price. Your minimum inflow is insured. Insurance or put option is how much insurance? 82 rupees. Pakka inflow will come. Not directly. Dollar you sell in spot market, here payoff you will get, overall it will be equal to strike price. Sir, what if option got lapsed? That's even better. If option gets lapsed, I will be happily selling my dollar at a higher spot rate, I will get more money. So can I summarize like this? If you hedge your FC receivables using options on the maturity day, your inflow will be either strike price, first case, or spot rate. Is this conclusion okay for you? Or you understand what I am trying to say? Either it will be strike price or it will be equal to spot rate on the maturity date. Now, why we are discussing all this is, in the exam questions are, that fellow won't tell you, some questions they tell you, some questions they don't tell you this. Your question will be like this. Up to here story I told you, no, Elaine, then he'll tell you, you have three choices: forward contract, money market hedging, options hedging. Do all the three. Suggest which one is the best method antaru sir. So best method only, how will you identify? Whoever is giving you higher inflow, what best method, isn't it? This you know how to work out, you will do. This also you will do. This option hedging, today action you will tell, you do this and one japtam. But at 3 months time, your option ka destination depends on what? Strike price versus spot rate. Until and unless you tell me future ka spot rate, I cannot close the options ka alternative. Are you understanding what I am trying to say? Forward contract I will decide today only. Means inflow, outflow, inflow amount I can freeze. Money market hedge also I can freeze. Options hedging lo, what problem you will face is, on the maturity date, what will be that fellow's inflow, you will not know today until and unless strike price, you know, spot rate is given to you on the maturity date. Some questions what they do is, assume future spot rate is equal to one number they will give you. If they give us like that, either case 1 will happen or case 2 will happen. We'll finish it off. Suppose question is silent. In your sir. Future spot rate you do not know, sir. Question nothing is given. What choice do you have? You are forced to make one assumption there. See and tell me which assumption is that. You are forced to assume that the spot rate on the maturity date is such a rate where option is getting exercised, and therefore your net inflow will be equal to strike price. Because this you don't know, the spot rate, but the number I know, this is nothing but the strike price. Once again, sir, when you do a hedging question, you will be given a situation. This fellow is having some foreign currency receivable. You have to do forward contract, you have to do money market hedge, you have to do option contract hedging, you have to do no hedging. 4 cases or 3 cases will be there. Forward contract lo how much inflow you will get after 3 months, I can identify. Money market hedge, I can identify. Option hedging lo how much inflow will you have after 3 months. If I have to do that, you should give me this information, no? Without giving me spot rate at 3 months time, how will I work out this closing figure? At 82, 84, 88, how will I know? I do not know, no. Question they won't give you. If they give you, well and good. We will do either case 1 or case 2. One thing will happen, we will do. If they don't give us, then what you have to assume is, the spot rate, I do not know, no, assume the spot rate will be at such a rate where the option is getting exercised. So option getting exercised means the end result is your inflow outflow will be equal to strike price. So we'll assume that and we'll close the sum. How people write that is, this fellow is taking delivery under options. Are they wrong? I can also say that I'm receiving $1,000. $1,000 I sold it literally under put option at a strike price of 82. If you remember like that, answer will be same only, no? What did I say? You sold it in the market at what rate? Spot rate. Call option, put option, you received the payoff. Overall, it is equal to strike price. Even if you do physical delivery under put option, also answer will be 82 only, no? What is physical delivery? I have a right to sell. I'm selling it under put option at what rate? 82. In that case also your inflow will be 82, but that is not permissible. You cannot sell your dollars under put option. Physical delivery not allowed. Shares allowed. Shares you have to do physical delivery only. Options, currency options not allowed. You cannot deliver currency or you cannot buy dollars in that. Not possible. You have to do this only. But if the question does not give you this information, you will assume that the amount I don't know. This amount also I don't know. In net figure will be 82 only. Because ఇక్కడ 75 కాదు సార్, I put any number below strike price, ఈ number will be 82 only, isn't it? Try 60, 60 inflow minus 60, ఇక్కడ 12 వస్తుంది సార్, 60 plus, sorry, ఇక్కడ 22 వస్తుంది, 60 plus 22, answer will be 82. You put any number below 82, answer will be 82 only there. As long as put is getting exercised, inflow is already locked. You have to assume that scenario. You wrote this example, below that you write. Sir, if it is FC payable, in that case what will happen? Same drama there also. Only thing is, instead of inflow, it will be outflow. It will be outflow. What's the last point number you wrote? Point number 8, huh? Okay, 9th point. Inflow oblique outflow on maturity date. Sir, we have to prepare a chart here. Okay, so plan space accordingly. For towards the last 1-2 lines, turn on to next page. First one, when question provides info about spot rate on maturity date, the ideal case they should give you. Why generally they don't give is, future lo what spot rate will be there after 3 months, how will that fellow know today? He will not know. He'll ask you forward is better, money market is better, options is better. Today you have to take a decision. But after 3 months, what spot rate will prevail? How will he know? He will not know. That's why he won't give you. At least estimated he should give that. Some questions they are giving, some questions they are not giving. No problem. Here you have to do A. Convert FC receivable or FC payable at the given spot rate. Settle call oblique put option payoff. Instead of settle, it is better if you write receive. because settle and word if I use paying payoff on a situation also will come, which will not be there because you will never become a writer for hedging. You will only become a holder. So receive is more specific. So receive call oblique put payoff on if I am writing means that obviously when option is exercise, that much mind you should apply. Okay, right side, that also I can write, but there is no point of doing a chart if you are writing so much. Right side, sir. Next case. When question does not provide any info about spot rate on maturity date. So first directly answer I will write, later on we will write the justification. Answer is simple. If you are having FC receivable, inflow is equal to strike price. If you are having FC payable, outflow is equal to strike price. That's the answer for this. Logic is this. You assume that the spot rate is such a rate where option is getting exercised. So here also you will do two things, but our two things will not be visible in your notes anywhere because the price is not given to you. So net answer only you will be displaying there. Okay, write logic first. Ideally, rule is rule. When sorry, we assume that spot rate on maturity date is at a level where the call oblique put gets exercised. And therefore for FC receivable, net inflow is equal to strike price, and for FC payable, net outflow is equal to strike price. Each chart is completed, sir. Put a small star mark below the chart, same point only. Apart from above cash flows on maturity date, also consider option premium paid. If you are doing an FC payable sum, final 3 months time you will have outflow only. Adi outflow, premium outflow, you have to add. If you are having FC receivable sum, finally you will have an inflow. Day 1 low there is a premium outflow, you have to minus. Data is given, time value of money, so you have to adjust because premium is at different point, maturity cash flow is at different time point. Time value of money, so you have to adjust. So this is the background story of options hedging. There is one more point, but that point I cannot make you right now. Directly the question only I can show you. So if you have copied up to here, one small question you can do. Come to question number 2. 2 is there, 3 is there. Which one is better? Whichever is lengthier. Sir, forward contract money market hedge you can solve. Okay, do. Zenith Limited places an order to buy a machinery with an American company. As per the agreement, Zenith will be paying $2 lakh after 180 days. Stop there. FC payable on in which currency? Dollar currency. Continue. The company ZL considers using number 1 forward contract, number 2 money market, number 3 option hedging, number 4 no hedging. 4 alternatives are in front of them. The consultant of Zenith collects and develops the following data or information as desired by the company, which can be used to assess the alternative approaches of hedging. Number 1, spot rate of dollar as on today is 47 rupees per dollar. Oh, stop there. Up to here, nowhere he told that Zenith is an Indian company, but looking at this rate, you can identify that dollar is anyway foreign currency. So rupee should be the home currency of Zenith Limited. Now you tell me what are the options hedging alternatives. Tell. You have FC payable, you have to pay dollars, means you have to buy dollars by selling rupees at 3 months time or 6 months time in this one. Tell me, if I am buying dollars means what is the risk? Dollar rate may rise. If I am giving rupees or selling rupees means rupee rate may fall. So rising market lo, which option? Call option on dollar. Or falling market lo, which option will you buy? Put option on rupee. So dollar call or put option on rupee, these are the 2 choices you have. Keep this in your mind. Rest of the sum you already know, sir. See, that fellow is giving you forward rate. Interest rates, India USK interest rates is giving. Okay, all that is for money market hedging. Next, future spot rate in 180 days as estimated by the consultant is 47.75 rupees per dollar. That means after 6 months time, what will be the rate he estimated? That means in this you will fall under this case, where question provides information about spot rate on the maturity. 5th and 6th point you see, a call option on the dollar which expires in 180 days has a strike price of 47 rupees per dollar and a premium of 0.52 per dollar. 6th point. A put option on dollar which expires in 180 days has an exercise price of 47.5 and premium of rupees 0.4 per dollar. Next page is asking carry out a comparative analysis and identify who is the best one is. Anyway, tell me sir, out of 5 and 6, one line is trap. Who is that? 6th point is trap. Why trap? There are only 2 hedging routes for you, sir. There is no third route. 2 routes are one. First route is what? Call option on dollar you should do, or you should do put option on rupee. What did he give you? Put option on dollar he is giving you. That is definitely waste, sir. That is trap. You should not touch that. So your answer is what now? Call option on dollar hedging. Like that you have to pick up. Since you already know that 2 routes are possible, one route is obviously trap there. Start all the 4 methods. Zenith is an Indian company having FC payable. How much FC payable? $2 lakh at 180 days. Actually, you can do 6 months because he is asking you to take 360 days in a year. But anyway, keep it like that. So where is alternative, sir? Alternative 1. Forward hedging. The question gave you forward rate. Bring it on. $1 is equal to rupees 47.50. So if you enter into this contract, each dollar you have to buy at that rate. So $2 lakh, what is the total cost? 95. Huh? This is your outflow at 180 days. Alternative 2. Money market operations. Since we have FC payable in dollars, create a FC receivable in dollars by making a dollar deposit. How much deposit you have to make is our deposit ka future value should be equal to your FC payable, so that our deposit and that payable will offset each other. So our deposit ka future value is $2 lakh. E deposit you are making for 180 days and you are making in USA. So USA ka deposit rate you pick up 3% per annum. So 1 plus 0.03. But 6 months deposit only, no, into 6 by 12, or you can do 180 by 360. Sort out this. One double four. Okay, 0.44 point. That you leave, or else write what is your point. So from India, you have to deposit that many dollars in USA bank. If you have to deposit this, first you have to buy this, no? So second point is spot rate today. $1 is equal to 47. 197,044.3 dollars. You have to buy. How much cost will it take me? $0.82 lakhs. Huh? Okay. This much money is required, sir. E money I don't have, no. So what I will do? Borrow. This is, you can write amount required today. Borrow rupees 9261,082.1 at the rate of India bank rate borrowing 8% per annum for 180 days. Same step only. Repayment amount at 180 days is equal to 9261,082.1 into 1 plus 0.08 into 180 by 360. 4% you add. Not right, huh? Correct only? Right. The option is gone already. Why this is gone? Forward contract outflow is how much? 95 lakhs. It already crossed 96. This is waste. But still you have to finish off. At 180 days, deposit made in step 1 will be used to settle the FC payable directly. Done. Currency option or option hedging. You neatly draw your story, sir. ZL or Zenith. Limited has a dollar payable 2 lakhs at 6 months time. So we have to buy dollars and have to give rupees. So here only you can write hedging route is, since dollar is likely to rise, risk. Sir, arrow marks are also risk points also. Dollar may increase other risk. So hedging route is here call option on dollar, or hedging route 2 is put option on rupee. This is what you are selecting. You are selecting means question load underlying asset is dollar. Question gave dollar as underlying asset. Therefore, buy call option on dollar at strike price of, what is the strike rate? 47. For rupees, what's the premium? Sir, all this you can do inside your mind and directly start with this. Okay, but in your notes it should be there. No? Next. Okay, premium paid. How many dollars we have to pay, sir? $2 lakh. So hedging also should be done for $2 lakh of call option you have to take. So $2 lakh into rupees 0.52 per dollar. 1 lakh. Definitely this is a outflow. There is no doubt on that. At maturity date, what will happen at maturity date? Two things will happen. Number one, buy $2 lakh at prevailing spot rate at 180 days, which is given in the question actually. Of course, estimated, but they have given previous month of 47.75. So $2 lakh outflow, please. 90 is definitely your outflow. P, confidently receive, right? Payoff received from call option. If you receive, you'll rate, otherwise you'll rate nil. I have a right to buy at what rate? Strike price is 47. Market price is how much? 47.75. So definitely option gets exercised. 47.75 minus 47 into is $1. Like that, I would have taken call for $2 lakh. So 2 lakhs into 0.75. 50 now, 1 lakh 50. Lakh. This is payoff and this is your inflow. net outflow at 180 days is equal to 9550 minus 150, 94 lakhs. If you carefully observe, 94 lakhs is nothing but strike price. Correct? $2 lakh into 47 rupees is nothing but your 94 lakhs. So anyway, but this is not over, sir. Total outflow in option hedging is equal to 94 lakhs whatever you are paying, plus on day one you paid a premium also, no? How much premium did you pay? 1,04,000. That also you have to consider. Plus 1,04,000. 95 lakhs 4,000. This is total outflow. Time value of money on option premium is ignored. Sir, why did you ignore? You tell me, how will I project it into 6 months time? I need interest rate. Interest rate is given, India interest rate? Not given now. That's exactly. Interest rates are available, no? Money market hedging interest rates in India is available, no sir? Then why did I not project? Why you did not project is, you have two interest rates, that's the problem. When will you use borrowing rate? If you assume that you don't have money to pay that 1,04,000 also on day one, you borrowed and you paid. Therefore, borrowing rate I have to project into future. If you use your own money from your pocket, then I have to use opportunity interest cost and deposit rate I have to take. So I say what they do is, generally when these two rates are there, they will not give any rate impact. They'll simply ignore it and they'll write a note. The ICA answers are not my answer, not treating my feelings. My feelings, why will I tell you? The ICA answer. You can check in the next page, solution is there. They don't give, they directly wrote this. The reason for that I am trying to justify. Why they did not write is, two rates are available for you to project. Each student will do one rate. If you really consider, you will not lose any marks and all, sir. You will be given marks. But suggested answer will be printed like this. Because two rates are there now. Each student might have done, somebody might have taken a borrowing rate and projected, somebody would have taken a deposit rate and projected. Some people might have not done anything also. So if you leave like this, then also it's okay. ICA says it's okay. Last alternative. Alternative 4. Actually, alternative 4 you just now did. What is alternative 4? No hedging. Sir, if there is no hedging, what will happen? Whatever dollars you have to pay, you will buy at spot rate. I think we also did in alternative 3. Option hedging also same thing. Option hedging extra, what is the benefit is, payoff you will get. Here payoff will not come. That's all. Do. Copy this. Copy that. Conclusion. Go and see who is lower. I think forward is better. Hedge means yes, you can do. You can do. But you are taking forward as the base. Then each is individually want to work out exchange gain. You can do that also. You can do that also. Sir, presentation, sir. If you see the answer presented in the next page, you will be shocked. Small cute answer they wrote. Look at options hedging. How much place we wasted, how much they saved. 2 lines rasid, sir. Final answer. Cut over. And why did I increase your story? Because our presentation of answer will be in such a way that it should help you in all the sums. This sum ki temporarily one answer if I give, in some other question if I present it differently, you will get confused. So I have to give you an answer which will hold good in every case. Sir, for doing this sum, this much of introduction I need not give you today, no. This sum given, sir, simple sum, normal. A call option you already know, I can close. But this much of introduction is given because this sum it may not be used. Next sum, everything will be, since you do not know what is going to come, you can feel that this is little heavy for you, but this is relevant only, sir. Little bit of trust. Anyway, see you in the next session.